Imagine this. You're walking into your favorite store and you see something you absolutely love. It's on sale and you've been eyeing it for months. You check your wallet. You don't have enough cash. But then you remember you have a credit card. You swipe it without thinking twice. Fast forward 6 months, and that shiny new item is now buried under a mountain of credit card debt, with interest rates that feel like they're growing exponentially. Does this sound familiar? The thing is, credit cards are marketed to us as a tool for convenience, but they come with hidden costs that most people don't realize until it's too late. In this video, we're going to break down the real cost of credit cards, how they keep you trapped in debt, and how you can avoid falling into this financial pit. Credit cards are designed to make you feel good about spending money you don't actually have. It's easy, it's fast, and it seems like a great idea when you're short on cash. The temptation is real, a shiny piece of plastic that lets you buy things immediately without having to wait. Instant gratification. That's the power of credit cards. Think about it. You get to buy something now and pay for it later. It sounds like a sweet deal, right? But this immediate gratification comes at a cost. In the short term, credit cards seem like an easy solution. But over time, the small balances build up, and you end up paying more than the initial price of the item due to interest charges. If you only make the minimum payment, the debt never ends. You're caught in a cycle of never-ending payments and rising interest. The trap of credit cards begins with interest rates. When you're not able to pay off your balance in full each month, the credit card company hits you with interest, and that's where the real cost starts to add up. Interest rates on credit cards typically range from 15 to 30% per year. That means every time you carry a balance, you're paying a hefty premium just to borrow money. For example, let's say you've charged $1,000 to your credit card and the interest rate is 20%. If you only make the minimum payment of $25, it could take you over 5 years to pay off that balance, and you'd end up paying more than $500 in interest. What started as a $1,000 purchase has now cost you $1,500. And it doesn't stop there. If you continue using the card and racking up charges, you're adding more debt to the already existing balance. Compounding your financial burden, the minimum payment trap is one of the easiest ways credit cards keep you in debt. While the interest rate is the most obvious cost of credit cards, there are hidden fees that many people don't realize until they see them appear on their statements. Let's break down some of these fees. Annual fees. Many credit cards charge an annual fee simply for the privilege of owning the card. These fees can range from $50 to $500 per year, depending on the card. While some cards offer rewards or perks in exchange, most don't justify the high costs. Late payment fees. If you miss a payment or don't make the minimum payment on time, you'll face a late payment fee. These can range from $25 to $40 per missed payment. And worse, missing a payment can lead to a higher interest rate and damage your credit score. Foreign transaction fees. Traveling abroad. Be careful when using your credit card. Many cards charge foreign transaction fees of 2% to 3% on every purchase made in another currency. So, a $100 meal overseas could cost you an extra $3 in fees. Cash advance fees. Need quick cash? You can use your credit card to get a cash advance, but it comes with a hefty price. Credit card companies typically charge a cash advance fee, usually around 5% of the amount withdrawn, plus high interest rates from the day the transaction is made. One of the most dangerous aspects of credit card debt is how it snowballs. When you don't pay off your balance in full, you end up paying interest on interest, creating a cycle of debt that gets harder to escape. Let's say you're in debt for $1,000 with an interest rate of 20%. In the first month, you'll be paying $200 in interest alone. If you only make the minimum payment of $25, your balance doesn't decrease much. The next month, you're paying interest on the higher balance, and the cycle continues. Over time, This cycle can cause interest to pile up, and even if you don't make new purchases, the debt will continue to grow. What seems like a manageable balance at first can spiral out of control into a mountain of debt. Credit cards don't just affect your wallet, they can also impact your credit score. The way you use credit cards can have a lasting effect on your credit report, which in turn affects your ability to get loans, mortgages, and even jobs. Here's how credit cards affect your credit score. Credit utilization, one of the most important factors in your credit score, is credit utilization, which is the ratio of your current credit balance to your total credit limit. If you're using more than 30% of your available credit, it negatively impacts your score. The higher your balance relative to your credit limit, the more it hurts your credit score. Late payments, missing payments, or making partial payments can severely damage your credit score. A single missed payment can lower your score by 50 to 100 points, depending on your credit history. New credit inquiries. Every time you apply for a new credit card or loan, the lender checks your credit report, which can cause a small temporary dip in your score. Too many inquiries can signal to lenders that you're in financial trouble. So now that we know how credit cards trap us in debt, let's talk about how to break free from this cycle. Here are a few strategies you can use to regain control of your finances. Pay more than the minimum payment. It's going to take you forever to pay off the balance. Try to pay as much as you can above the minimum. Even an extra $50 or $100 a month can make a big difference in reducing your overall debt. Pay off high-interest debt first. Focus on paying off the credit card with the highest interest rate first. This strategy, known as the debt avalanche, saves you the most money on interest in the long run. Consider debt consolidation. If you have multiple credit cards with balances, consider consolidating your debt into one loan with a lower interest rate. This can make your debt easier to manage and save you money on interest. Use cash instead of credit. Avoiding credit cards altogether can be a great way to keep yourself out of debt. Use cash or a debit card to make purchases. This ensures you only spend money you actually have. Avoid unnecessary purchases. Finally, the best way to prevent credit card debt is to stop using credit cards for unnecessary purchases. Ask yourself, do I really need this? If you can't pay for it in full, it's probably best to wait. Credit cards are often seen as a convenient tool for managing your finances, but they come with a real cost, one that can leave you trapped in debt for years. By understanding how credit cards work, how they trap you, and what the real cost of credit card debt is, you can start making better financial decisions today. Remember, credit cards are not a free pass to spend recklessly. They are a tool, but like any tool, they must be used responsibly. The next time you think about swiping that card, ask yourself, is this really worth the long-term cost? If you found this video helpful, don't forget to hit like and subscribe for more tips on managing your finances, escaping debt, and building a secure financial future. Take control of your financial future. Stop relying on credit cards. Start paying off your debts and begin building your wealth. You can do it.